Look at their 5-year free cash flow. That's what you need to do as an investor. Awesome. Could not complain about that. Almost 3 times more. That's incredible. It's just these 2 metrics that drive me nuts. NVIDIA stock has been on a tear this year. Let's just look at it year to date. Let's pull it up. And in our software, year to date, it's up 92.7%. It has almost doubled year to date. If that doesn't automatically ring problems for you, I would question that. Now, NVIDIA, if you look right here, in the last 5 years has averaged $4.9 billion in free cash flow. Okay. Pay a small dividend. Decent, a very high return on invested capital. I'm not going to look at earnings right now because what I want to do is make a comparison. Now remember, guys, this company, 28 times price to sales ratio. That means for every dollar in revenue, somebody's willing to pay 28 times that. And their profit margin is 16 to 5-year average is 27%. And the chip industry is having a little bit of a lull right now. Revenue's down a lot. But the reason I bring this up is this company's market cap is $685 billion. There's another company by the name of Berkshire Hathaway, owned by Warren Buffett, that is less market cap, $678 billion. Now, look at their 5-year free cash flow, $24 billion versus $4 billion. Now, you might look at the net income saying, but Paul, they lost money. No, they didn't lose money. The way the IRS and SEC handles things is when their stock prices, when their stocks that they own go down in value, they have to mark it as net income loss. In the last 5 years, their PE is 16, including that loss. But let's focus on their cash flow because that doesn't get modified. Their 5-year average free cash flow is $24 billion, guys. NVIDIA is $4 billion, and they're the same price company. And the difference is Berkshire Hathaway has over 80 wholly owned businesses under their umbrella, not even including their stock portfolio. Wholly owned businesses under their umbrella. I don't understand how people look at this. And this is what I sit there and say, when you're comparing companies, when you're going out and buying a car, if you can buy a Cadillac for $50,000 and your idiot neighbor has a Ferrari who's willing to sell it to you, a brand new Ferrari for $50,000, would you sit there and say, I'll take the Cadillac? No, you'd sit there and say, I'll take the Ferrari. And that's what I look at with Berkshire versus NVIDIA. Why would I pay $685 billion for $4 billion in cash flow when I can pay a little bit less to get 6 times more cash flow? And I'm not saying Berkshire is a buy. I'm just saying that's what you need to do as an investor. You need to be able to keep things away from the story. Now, if NVIDIA could grow its cash flow at really, really high rates for a very long time that justify the value, great. But when I say really high rates, my guess is they have to grow at 30, 40% above Berkshire's growth rate. And that's going to be very difficult to do. I haven't done the math on it, but those are the stories you have to be able to tell in order to justify the price of a company today versus this. And look at NVIDIA. Their fluctuations in revenue are way higher than Berkshire. Berkshire's got 80, 90 wholly owned businesses. They got stock portfolio. They got insurance businesses that spit off cash that allow them to invest at higher rates of return on basically free borrowed money. NVIDIA makes chips, and they make wonderful chips and awesome. Could not complain about that. However, this should be a lesson to you, and I'm hoping it's like, wait a second, I didn't realize that. Because when people buy stock, they look at the stock price, not what they're buying, the market cap. That market cap is buying all the shares outstanding. So if you're paying $685 billion for NVIDIA and $678 billion for Berkshire, but yet you're getting this versus one-fifth of this, why would you even be considering NVIDIA? NVIDIA is very, very, very overpriced. But let's do the math with our stock analyzer tool to determine the price of NVIDIA and what we should pay for it. Now, guys, the hard part about NVIDIA is, like I said, the revenue is down significantly. Why? Well, guys, the chip industry went through a boom last year. Look at this revenue drop. Like pretty much almost every chip maker has seen this. $29 billion down to $22. It's okay. They can still make money, and they have, and they can still grow and still be worth something. It's a temporary lull in the business. Just like when Southwest went through COVID, their revenue fell by 90% or whatever, 95%. Doesn't mean Southwest is going away. They had to rebuild that. And now they have higher revenue than they did before COVID. So the same thing applies to NVIDIA. Let's look what analysts are saying about NVIDIA. Analysts are saying that NVIDIA's profit could go from $333 a share this year to $855 in 5 years. That's almost 3 times more. Not quite, but almost 3 times more. That's incredible. Okay. What about Berkshire? Probably not the same. So let's go pull that up. Berkshire is probably going to have a much slower growth rate, according to analysts. Oh, well, Can't really look at that right now because there's not many analysts following Berkshire. Don't know why that is, but they have about the same, a little bit higher. So it's not much in terms of growth rate. So yeah, that's a positive for NVIDIA. But again, you're starting out with 6 times more 5-year average free cash flow with Berkshire than NVIDIA. Is NVIDIA a much more exciting company? To some, you know what's more exciting to me? Paying less money for more cash flow. That's way more exciting to me. So again, let's go back to NVIDIA and let's look at they're expected to over double revenue in the next 5 or 6 years. So let's look at the 8 pillars here real quick. 133 times 5-year earnings, 140 times 5-year free cash flow. Guys, it's very difficult to justify these for such a large company. If this was a small company that did $1 billion in revenue, I'd say, okay, if they can grow a lot, 30, 40% a year for 10, 15 years, this company ain't growing 30, 40% a year for 10, 15 years. It's just not going to happen. If you look at the analyst estimates, they're looking at, about 10 or 15% for the next 5 or 6 years, okay? Now, high return on invested capital. Love this. This means that every dollar they reinvest in the business, they can really spit out a lot of profit there. This is awesome. This is a great metric. This isn't so bad. Shares outstanding up 3.8%. I don't blame them. The stock's overpriced. Sell out shares to get your money. Don't take on debt. I don't blame them for this. Everything else looks great. Low debt, cash flow growth, revenue growth, net income growth. It's just these 2 metrics that drive me nuts. And guys, it's very, very possible and actually very likely that people in the markets will overpay for a good story. It builds on itself. That's how a stock goes up 100% in 3 months. 93% that NVIDIA stock is up in 3 months. That's crazy. In fact, I think the low for NVIDIA was $108 just 6-7 months ago. $108. Now it's at $276. So what's NVIDIA stock worth? Well, guys, this is the stock analyzer tool. It's been used over 1.3 million times by our users in our community in the last year. It is awesome. What it does, it allows you to make assumptions about the future. And I'm going to make a low, middle, and high assumption. And I'm going to do a 20-year analysis on NVIDIA. Because I think NVIDIA will be around for a very, very long period of time. And it's a great company to own. The question becomes, at what price is it a great company to own? That's the thing that a lot of people miss. That's why the fact you've made it this far in this video shows how smart you are. You realize it's possible to overpay for a good thing. There's a good price for everything. NVIDIA at $1 all day long. NVIDIA at $10,000 a share, avoiding it like the plague. The exact same company. So somewhere in the middle, there's a good price to pay for the company. But the thing is, we don't know the future. So allow me to really quickly put in my assumptions, explain them, and it'll spit out, based on my assumptions, what the stock I should be paying for the stock today to get the return I desired. So please hang on for 1 second. All right, guys, so these are my assumptions, and they're very wide assumptions because the longer we go out, these differences in assumptions make big differences overall, right? It's just like a shotgun. You start a shotgun from here. As it goes out further and further, it becomes wider and wider. Same thing with valuation. I'm going out 20 years, so there's going to be very wide ranges. But I'm also making these very wide ranges. Look at revenue growth. I assumed 4% on the low side, 12% on the high side per year. Now, just to give you an idea of what 12% means, 12% for 20 years takes their revenue to $212 billion from $22 billion. Okay, that's pretty substantial. It's 3 times larger than Intel today. So it's not egregious. Now, if you don't agree with me, you know what? Let's go a little bit higher. Let's go 4, 9, and 13. Okay, we're gonna go a little bit higher. Probably takes you to, let's see what that takes you to on revenue assumptions 20 years from now. 11 times growth, $250 billion in revenue. Okay, now profit margin. This last year was a lower profit margin, 16.8%, but in the last 5 and 10 years, much higher. So I did 20, 24, and let's say they crush it and do 28% for the next 20 years. Okay, oops, a video just came out. Exclusive video. Free cash flow, I did the exact same thing because over long periods of time, earnings and free cash flow should be pretty similar. And if you look right here at their history, they're very similar. So I'm okay doing 20, 24, and 28. Now, PE. If you're like that idiot Meet Kevin who thinks that PE of 160 means a discount 70, just turn the video off right now. I can't teach you anything. Guys, history dictates for a $685 billion company, the market average of 15 or 16 PE will base. Now, should you pay higher? Yes, they have a high return on invested capital. It means high moat, and they can really keep their profit up very easily with less money invested. So that's why I put my minimum at 15 and my high at 18 and 16.5 PE in the middle. Now, that might sound confusing to you. I understand completely. It takes some iterations. This is why you sign up for the community. It's $1 a day, $7 for 7 days is a special we're running right now, and the price is going up very soon. We're going to end up being at $40 a month, over $1.30 a day very shortly. So sign up now so you lock in that rate. Now, desired return is our last metric. Guys, I already beat up the company pretty nicely here. So I'm putting 9% return in. I'm like, okay, listen, if I can buy NVIDIA and they screw up, which I think this is a screw up, and I still make 9%, that's awesome. But as I get my assumptions higher, I need a bigger threshold. I did 9, 11.5, and 14, because I do believe this should about be what happens with the company. Okay, they can grow their revenue, all these things, 11.5% and 14%. I hit the analyze button. 6 numbers are going to pop up. A low, middle, and high for earnings and a low, middle, and high for free cash flow. This is going to show you how NVIDIA is so massively overpriced. Low price of 37, high price of 93, middle price of 60. Guys, I want to show you one thing before you go. What has to be the growth rate for NVIDIA to justify today's price? I'm at 20% growth rate per year and it's still not there. And 20% growth rate would take them to $843 billion in revenue. Guys, thank you for watching the video. Hopefully you see that the story for NVIDIA has to be really different than what's been happening in history for this to justify today's price. Thank you for your time.